Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Phil, welcome to episode 6 of this insurance miniseries, this personal insurance miniseries.
Thanks for having me.
We're talking how to review or adjust your cover. If you've got things like life insurance, trauma, income protection, child's cover, these types of things, we're going to be talking about them today. And this is really important because most people, most of the time, aren't in the middle of doing an application for a new insurance policy. They've already got one, or they don't have any and they need to get one. So that normally happens in a space of maybe a few weeks, maybe a couple of months, depending on the journey. But most of the time, people have insurance. And so we're going to talk about that and what goes into maintaining that and keeping on top of like relevant things to make sure that you always have the right cover. Now, in the previous episode, I did mention that I hold a lot of insurance through super. I went back and checked, I have about 1.27 million of death and TPD through Australian super and $6,000 per month of income protection. Now, I think, as you alluded to in previous episodes, I think that might be a agreed value, which is maybe not, I don't know, to be brutally honest with you. This was quite a while ago when I put this in place. Now, this episode is all about how to review your insurance cover. I just checked inside the Australian Super app, to be honest. And it's also about like how to adjust cover. So in the case, that someone has insurance, right? What is the process of reviewing and adjusting? Like if I wanted to adjust that, what would I need to do?
Yeah, good question. So, I mean, just before we go any further, because I'm a bit OCD, it wouldn't be agreed value because it's with Australian Super. So,
okay, that's good to know. That's good to know.
So if your income's less at the time of claim, you won't get paid that $6,000.
Yep.
But how to review cover? So, life changes. One thing I would say is life insurance is different to general insurance. You don't want to be going and reviewing every 12 months your cover because of the requirement for medical disclosures. So for me to change my home and contents insurance, it takes me 5 minutes to do online to compare and to change it. It's really easy. Same with car insurance. Life insurance, it's a much bigger process to move insurers. So if you go and decide actually 1.27 million is way too much, let's bring it down to $1 million. Then that's a relatively straightforward process because the insurance company is taking less risk by insuring you for less. They'll charge you less in premiums. So it's always really easy to reduce your cover. Increasing your cover is just another thing of you got to go through the medical disclosures. So my advice is definitely get advice in terms of the level of cover and the right product. But if you don't want to get advice and you want to go straight to your super fund and stick with the Oz Super, then you got to contact Australian Super and they will refer you on to TAO to go and increase that cover.
Okay. In episode 2, your big takeaway from that episode, and the episode was titled, if I do have it correctly, that was about lump sum insurances, so about the ones that pay out in the big lump sum, life, disability, trauma, child's cover, etc. Your big takeaway from that episode was, how much do I need? Like to ask yourself, how much do I need? And is it reasonable? You didn't say if it's like precise. Now, when it comes to adjusting or reviewing cover, this is probably a bit of an out there question. So, there's like online calculators. Some people say that those are really risky and some people seem to Reddit seems to swear by them. But like, do you have a view on that? Using those types of tools?
I mean, to be honest, I don't mind so much. I just wouldn't, and same as looking at advice. I think we talked about in a previous episode, I'm a skeptical human being at my core. And it's probably not super healthy, but I am. Just like getting advice, don't just say yes to everything the advisor says. And same with online calculators. Don't just go, oh, well, the calculator told me to do so it makes sense. So one, a popular formula that Barefoot Investor used to talk about is just cover lump sum or life and disability 10 times your income. And my concern with that, just we can pull apart the way we view the levels of cover, is if your income is, $40,000, but you've got a household mortgage of $1 million, then you're going to cover your life and disability for $400,000, and it's not even going to go half the way towards that debt. And same as if you've got an income of $250,000 per year, and you've got no debt, then do you really need $2.5 million worth of cover? So sometimes, just critically think about any of these formulas that come up. And at Skye, we've got our own formula and our own philosophy, and we expect our clients to critically think, is our philosophy reasonable for them? So that's kind of, I don't have any issues with online calculators, but just think about, okay, what are their assumptions? Is that fair and reasonable for myself?
Yeah. Yeah. That's totally cool. So I just wanted to talk about this. Like, there are some bigger life events when people, I think, should get financial advice. Things like approaching retirement. If you're unsure in any way, you should speak to a financial advisor and get proper financial advice. And again, as you just said, I would say be critical, or skeptical is probably the right word, not critical, but be skeptical of the advice and make sure it fits what you want, even if you're seeing a licensed financial advisor. And the same, there may be other life events earlier in life when it's really important to get financial advice. Like maybe you're planning for a house and you don't know the first home super saver scheme exists. Maybe you do and you're confused and you want to get help. Maybe there's been a death in the family and you've inherited some money. Maybe, you've got a business and you've sold it. Whatever the case may be, there are particular events, Phil, in people's lives when I'm really keen for them to get expert advice, even if it costs them a fair slab of money, because it will probably be worth it in the end. When it comes to reviewing things like life insurance, income protection, when should people be thinking about that?
Yeah, so I mean, the way I think about insurance is when to get it is if you've got an income you rely on and others rely on, you should be getting insurance in place. And so that's most people in their full-time work, who aren't living at home. So that's when you should obtain it, in my view. Now, when do you review it over time? It's things like mortgages. If you go and get a home loan, you've now got $400,000 of debt that the bank will not just forgive if you pass away. They will come after that money very quickly if you can't service that loan. So that's one big area. And the next is kids. And that's when, cash, for any young families out there, that's when cash flow gets tight very quickly. And insurance is one of those things that's like, well, when cash flow is tight, should we get rid of it? And in my view is, well, if cash flow is tight with the insurance premiums, imagine not having that income to service that, that requirement. So that's kind of when insurance is kind of most critical, even when it's the least affordable from a household point of view. Other things, we talked about income protection being very nuanced at claim time. So any major increases or decreases to income is really important. So when your income just creeps up over time, then that's okay. Your insurance, depending on how it's set up, may be increasing over time. So, Owen, your income protection wouldn't have increased over time. But if you set up through a financial advisor, it incrementally goes up over time. So that's okay. But if you've gone and gotten a massive pay rise or changed occupations, that's important. So the one thing to note with insurance is, especially income protection, if you've gone from a low risk occupation to a high risk occupation, you don't actually need to go back to the insurer and tell them. It's already built into the contract that it's guaranteed renewable at the time you set up the policy. But if the opposite is true, if you're a plumber, which is considered a higher risk, and then you become an accountant, then that's a lower risk. That's when you may want to go and update your policy and let the insurance company know, and they may price in that lower risk occupation. So just to recap, children, debt, and changes to your occupation. And that's kind of the increasing areas. And then the decreasing is like when you're getting close to retirement, how much do you actually rely on your income? If you're less reliant on your income and you're working out of just a choice or a lifestyle decision, hey, I'm here for community and whatever other reason. And if you lost your income, maybe it doesn't have that big an impact. That's when you start to consider reducing it or cancelling it.
What about, Phil, if someone's listening to this and there's like a husband and wife duo or whatever the case may be, and one of them's about to go off work, is it let's say, for example, one partner's not going to work full time for, they don't, maybe ever, but let's say maybe at least 3 to 5 years because they want to be at home with the kids, whatever. In that situation, is it pretty common amongst the Skye clients that person might adjust their cover down, or is that typically not advisable?
So it depends on the cover. So income protection, it's just a conversation of I'll dive deep into this question because it's very common. It happens with a lot of households.
Imagine.
So with your lump sum cover, I wouldn't say reduce it because
Still the same concept.
again, if my wife passed away, I'm buggered. Like I'm stuffed. I need to take time off work, and it has a massive financial impact on our life. But the income protection is really nuanced because if I know that Kate has got a policy we're paying for and she claims on it and isn't going to get anything, then we may want to cancel it. But it's not a blanket rule, definitely cancel. Because if prior to having babies, Kate is my wife. If my wife has a health event like that, we know she's not going to be able to get cover in the future, then we may want to keep paying that policy, even though at claim during that, parental leave, she's not going to get paid anything. We know once she's back at work, she's got that cover again, and she will be able to claim. So it's not a blanket rule. Definitely cancel your income protection. It's a rule of if you are uninsurable again and you think you will return to work and income protection is important to you, then you may want to keep it. But again, it's just one of these things. Go and get advice and have that conversation.
Yep. And that was kind of going to lead into my next question, which is more just about the ongoing cost of insurance. Are there ways that people can manage that, or just at a higher level, ways that people, like if you're giving advice to someone or your team's giving advice to me, ways they might suggest that there are ways to keep costs under control?
Yeah. The great thing about insurance and life insurance is there's so many levers to pull. It's not a matter of just keep it or cancel it. And I think I said this in one of the earlier episodes. You can keep it, reduce it, increase it, or cancel it. So as costs go up, you can then start to go, hey, do we actually need this level of cover? Or maybe we need a level of cover, but the cost is really prohibitive. Okay, are there ways of just dialing it down by 50 grand every year until we, cancel the cover outright? So there are those kind of mechanisms when it comes to insurance to manage the cost, but it's really just a kind of a personal view of what is important to you. And, we look at our costs in life and costs is going crazy at the moment. And we're like, oh, let's just cancel it. Well, as I said, do you need 1.2 million? If the cost is really prohibitive, maybe we just go to $1 million and that'll save you money. So there's heaps of ways you can kind of mitigate that increase over time.
Okay. Another thing is you did mention with car insurance and those types of general insurances before, which fall under a different regime. We talked about that in the first episode. Those are the types of things where you should be setting that calendar reminder, and you should be for every year, 3 weeks before, say, your car insurance comes up for renewal, go and shop around, because you oftentimes end up paying more because there's a loyalty tax with those things. They offer discounts to newer insurance holders rather than the existing cohort who they just assume won't check. So they just pay more. Is there any mechanism like that with life insurance? Should people have a cadence where they check in? Should they, is it anything like that? Or is it just more like when those big life events happen, that's the trigger?
I mean, it is. So the loyalty tax is a thing within life insurance as well. And the reason why they build it in is more because they underwrite you today. So it's cheapest and most, assessed. They assess the risk today. So in 5 years' time, there could be some health issues that are built in. So they price that in. So it is a loyalty tax. But the difference between and this is why we started this whole thing talking about legislation, the different forms of legislation. And the reason why they're important is because general insurance or car insurance, they can reprice your individual policy based on you having 3 car crashes in the last year. The Life Insurance Act, they can't reprice your policy because you've taken income protection for 12 months. So that's why life insurance is not just a set go and review every 2 years or every 12 months like it is under general, because the Life Insurance Act doesn't allow the insurer to penalise you for claiming. So again, it is worth reviewing on a regular cadence. But if an advisor says keep your policy where it is today and don't move it, it's not because they're kind of biased and want you to maintain it. They'll actually make more money moving it because you got to do that disclosure requirement again. There's a lot of health requirements that come into fact. So for me, I've got a policy without any exclusions or loadings. Now, if I go and I went to a specialist last year, fortunately that didn't impact my cover. But if it did, then I'd have an exclusion. And so do I want to save, 5% of my premiums for that exclusion? Depending on the exclusion, it may make sense, it may not.
Yep. One thing, I've only got a couple more questions for this episode, but including the action point that people can take away. But one thing I don't think we've talked about so far is the idea of step versus level premiums. Can you maybe just some people might have heard that that phrase stepped versus level. Can you just talk about that?
Yeah, within insurance, and this is set up via a financial advisor. So if you go direct, I don't believe you have these options. If you go through a super fund, you don't have the options either. But this is through an advisor. So level premiums is more expensive today. So you're paying a higher premium today, but the premiums don't increase just because you're getting older. So step premium it's priced as your age today, and then every year it gets repriced on your age at that point in time. So now level premiums aren't they're not flatlining. They don't stay the same all the time. So premiums can increase for two reasons under level. So number one is if your level of cover goes up, then they're offering you more cover, so you're going to get charged more in premiums. The other reason is insurance companies can reprice their whole business. So they can't go, hey, Owen, you've claimed on your income protection last year, so we're going to charge you 20% more. But they say, hey, Owen, Phil, and everyone else who's with us, we've had higher than expected claims experience. Everyone's getting a 5-10% premium increase. So they do it across their whole business. And so stepped premiums can increase those two reasons exactly the same. But then the third reason is, hey, you're just getting older. You just cost, you're higher risk, so we're going to charge you more.
Mm-hmm. Level premiums would sound appealing to people earlier on in life because if they could almost quote unquote lock in a better deal in the future, they might be inclined to do this as they're younger and have fewer conditions, medical history and that sort of stuff. Do many clients that come through to you guys at Skye and meet with your advice team, do many of those come through?
Yeah, so exactly right. So the level premium, the break even is a long way away. So it's kind of like an investment philosophy. If you think you're going to hold this investment for a long time, which is the best thing to do, then that's a good way to invest your money. It's the same with insurance. If you think you're going to hold this policy for a really long time, then level premiums can make sense. And just full disclosure, me and our head of advice in our business, we're interviewing all of the major insurance companies' actuaries and having this really candid conversation about, hey, where do we think the future of level and step premiums is? Because there are a lot of advisors who will swear black and blue in the face that level insurance is wrong, and vice versa. There is plenty of advisors who say step premiums are wrong. You talk to 10 different advisors and you get 11 different opinions. So we're trying to talk to the actuaries and talk about what is the future of what's placing our clients in the best position. And so, we have a very strong house view in our business, but, just like every good business should, review our own house views. Is it reasonable? And we're talking to the math geeks at the insurance company.
That's good to know. It's like when you go to the vet and they all say a different thing every time you go to them, like, don't get that pet food, get this one. And it's at the same veterinary clinic and they all just can't agree. It's just a real problem. I hate seeing that type of thing in real life from professionals. So to know that you're going to the source, to the math geeks that actually price all this and have to have a view on the future and have to look at all the numbers, that's really great. So I do know a financial advisor, a friend of mine who got insurance, level insurance when he was 18 or 19. He knew because he was studying financial planning. He just went straight to it. He's like, that sounds like a good idea. And 20 years later, he's happy days. But that's something that people, I don't think we covered in previous episodes. So I just want to get that in there. So something that people can talk to the Skye Wealth team about when they go through that is just the difference between stepped or level premiums. So the thing I wanted to now talk about, and this is why that question was important to ask first, is we do have a lot of listeners to our podcast, Phil. In fact, there's a huge proportion of people in our race community that are 50s, 60s, 70s, late 40s even. In fact, that demographic is way bigger than the 20s cohort, way bigger. So for folks that are, say, approaching retirement, in retirement, do you have any house view, let's say, just as a general view? Obviously, everyone's case is different, which when they go through the process at Skye, meet with an advisor, they can talk about that. But is there a house view on when is the right time in life to start reviewing if I need this much insurance or insurance at all?
I mean, we love insurance. We think we should be the center of everyone's financial lives. So we think reviewing your cover is really important to do, like at any point in time. If you haven't done it for 5 years, go and do it, because you may be completely underinsured. Like one of the first episode we talked about that call to action. Just go and look at your policies and check how much cover you've got, just so you're aware. Because like, everyone loves talking about, wealth creation. Like there are a million books about wealth creation, a million, seminars you can go to about wealth creation. But wealth creation gets completely destroyed if a health event happens. Like Zurich, one of the major insurers, came out with their cost of care, and they talk about I forget the stat, but there's a huge majority of people retiring early purely because of health events. So retiring well before they want to, because they can't continue to work for health reasons. And that's a pretty significant number. And so again, for us finance geeks, we know that the last few years of your, working life is where you really maximize your wealth creation within super. But if that isn't available because of a health event, then you're going to miss out significantly. So I always talk about insurance. It's just downward protection. We don't all invest 100% of our money in crypto because it's too high risk. So why do we go through life without insurance or without reviewing the insurance? So again, whether you need to reduce it or increase it, whatever life stage you're at, it's just important to go and review your cover, because products change over time, and your product you're in may be really good or it may not be good. So yeah, there's no house view of when you should, other than today.
Yeah, that's fair enough. And if you are approaching retirement, or if that is kind of on the horizon for you, go and get advice, because it may actually be a significant, benefit to you to either get the right cover, as Phil's alluding to, or even to readjust it, because you may have set it up like I did a few years ago, kind of forgotten about it, and that's no longer appropriate because your mortgage is lower, your kids have moved out, like so many different things that happens in life. So go and check that out. Now, Phil, every episode I do ask for a call to action. We're going to put this into a bit of a PDF or some sort of checklist for people to go and check out. If you want to go through the Skye Wealth insurance journey, just as I am right now, you can head to the link in your show notes. That's always available there. You can get insurance advice. What's your action point for this episode, mate?
Well, I mean, actually similar to the first one, just check what you've currently got, and go and review it. Think about, have you had any of these major life events that we talked about? Major increase or decrease to income, and whether that's parental leave or actual promotions, mortgages, marriages, any of these major life events. If you've had that in the last few years and you haven't reviewed your policies since, definitely go and review it. Whether it's through a financial advisor, which I recommend, obviously, or whether it's just doing DIY, make sure you just review your cover.
Cool, got it. Yeah. So just go beyond just looking at it, as you said, and actually ask yourself, has something changed? Has something really important changed? And do you consider that to be the right level of cover and those types of things? That's great, mate. All right, we've got one more episode to go, which is the question, which is the topic that probably sits at the end of someone's insurance journey, which is making a claim. And this is probably a daunting time in people's lives. So we're going to tackle that next, what to do, what it looks like. It'll be a pretty brief episode because it's quite nuanced, but it's really important. So stay tuned for the final episode with Phil Thompson from Skye Wealth. Phil, mate, absolute pleasure.
Thanks.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.